Selling your business may be one of the most important personal and financial events of your lifetime. It requires careful planning as the decisions you make or fail to make can impact the attractiveness of your company to prospective buyers and limit your ability to maximize on your investment and optimize your tax position. Is your company ready? Are you? To answer this, you need to see the whole picture. We are a unique collaboration of 4 leading global advisors. Working together, we can help you put all the pieces in place and make sure nothing is overlooked. We are Exit Plus. Joining me from London is Chris Rose at Dentons. From Washington, Chris Opie at Bernstein Private Wealth Management. From New York, Eric Gelb at PKF O'Connor Davis. And from Amsterdam, Mark Carmichael at STS Capital Partners. In this video, we will address some issues on tax and restructuring. Thank you for joining us. I am Shahnaz Nasser with Dentons. Eric, having high expertise in this area, what can you tell us about how value can be maximized through tax planning and restructuring?
That's a terrific question and is integral to the M&A sale process. Thank you. So what we see is it's really, as you would expect, not the top line cash you get, but what you keep after all the various taxes. So most of the businesses we work with today are global and they have businesses and divisions in multiple countries. So each of those countries typically has a separate tax regime, a tax code, and different aspects and exit payments, if you will. So figuring out the basis, what will give you a sense as to what you have as potentially unrealized gain or unrealized loss. Looking at how your entities are structured. Are they flow-through entities? Are they corporations, partnerships, and whatnot? And are there ways you can change that structure or perhaps transfer assets and revenue from one entity to another inside the overall organization? And then do some projections on the taxes that you might incur, given, as Mark was saying earlier, a share transfer or a swap of shares, whether you're staying, how much cash you're getting, which entities do you sell? Do you sell assets? Do you sell stock in some of these entities you have to implement the overall sale? So by taking stock of where you are in a tax situation, and then working with your advisors closely, and then figuring out what's the best structure to sell should help you maximize your after-tax proceeds.
Eric, thank you so much for kicking that off. I'll add my thoughts from Bernstein's perspective. Ultimately, we recognize that humans own businesses. And when the sale occurs, we need to look after the corporate issues, but then also the downstream personal tax implications to maximize that which is kept in the pocket, Eric, as you said. Clearly, this is a hugely divergent topic in the various geographies where our clients reside and where they conduct their business. Ultimately, we're normally focused on income tax issues, both the actual income received and capital gains issues, and then downstream in the pursuit of creating and preserving intergenerational family wealth, estate taxes, inheritance taxes, as wealth is handed down over the generations. We're blessed, fortunately, at Bernstein to have a wealth strategies group, professionals who are now with our firm no longer practicing, but grew up in trust and estates, tax, and in some cases investment banking backgrounds. And so ultimately those individuals will partner with a Bernstein advisor and the likes of Eric and Chris and Mark on the phone to make sure that we're putting together a plan which works across all the different facets that hopefully you're coming to appreciate during this video series makes so much difference. I will just share one small example, which is the state of affairs in the United States today, with tax rates likely going in one direction over time. We're very conscious of the tools which do exist. For example, the use of opportunity zone investments to mitigate capital gains upon the sale of a business, the identification of a client's charitable interests to mitigate income taxes in the year that the transaction takes place. And also where there's an opportunity for an individual to leave the United States prior to a sale. If their intention is to go back to a home country or to relocate somewhere prior to a business sale, that can yield tremendous opportunities that dovetail perfectly with the family's personal aspirations.
Great points, Chris, and Eric as well. And look, I think the only thing that I can add that's appropriate for me in this context of this discussion is that the sellers should be very clear on the two principal ways in which a buyer acquires a business, and that's through either a share purchase or an asset purchase. And just very quickly, in a share purchase transaction, the buyer acquires all of the shares, unsurprisingly, in the company which carries on the target business. And conversely, in an asset purchase, the buyer is acquiring identified assets and rights of the business, and may sometimes assume, responsibility for certain liabilities of the business that's being acquired. But the two different structures, to your points, both of you, have different tax implications for both the buyer and the seller. So something that those on this call are probably better equipped with to discuss than I. But in any event, you'll want to ensure that you understand the pros and the cons of the share purchase or the asset purchase structures to make an informed decision that's going to be the most appropriate for you.
Sure. Just adding to that, without getting technical, a share sale is probably the default position for most sellers, but an asset sale is faster. There's less due diligence because they're just taking away this piece of the business. Typically, we see that more where maybe the company has potential issues where they just couldn't mitigate and they end up going an asset route. But I think depending on where you see yourself after the transaction, an asset sale will require you to deal with the underlying business going forward and liquidate. So that it's not just to turn the key and hand it over.
Thanks, Chris. Eric, would you summarize the 3 takeaways viewers should take note of, please?
Well, tax planning and analysis is really essential, and figure out what are the drivers and what are the possible tax benefits and ramifications of any particular sale. And then once, of course, you have to negotiate with the buyer, right?
Mm-hmm.
And work with advisors like Mark. But then you try to get a structure which maximizes your after-tax proceeds. And we see the transfer or the sharing of these tax costs and benefits between buyer and seller is pretty commonplace. And then the other thing is, as Chris was saying, really important to think of your own family and intergenerational wealth planning and legacy, whether that's gifting some shares or planning in a certain way so that you can achieve your personal wealth and philanthropic goals.
Lots to digest there. Thank you. And thank you for watching. How exit ready are you and your business? Find out using our free exit readiness assessment. Simply complete our confidential online survey, which should take you no more than 10 minutes, and we'll prepare and send you your personalized report together with your readiness score.